how a trader can make money in the commodity markets, some trading strategies, some technical analysis on the markets, and basically what all mistakes a trader does when he's trading in the markets, how they can avoid those mistakes, how they can take care of the whole trading scenario, and then we'll be taking the question and answers at the end of the webinar. So we suggest everybody to listen to the webinar. If you have any queries, do note them down, and then we'll be taking all the queries at the end of the webinar. Now about the EPIC Empowering Investor Program. What we believe that in the markets still the financial literacy is at a very low. Although the investor base is rising day by day, but the investor education, the financial literacy is very, very low among the investors, especially the retail investors. Normally a retail investor comes to the market, he trades, he starts trading with a very positive view, with a very good enthusiasm, but then he stops trading after 6 months of his account activation. So this is the reason we are doing this particular webinar. So we'll educate all the traders, investors in the markets to how to trade in the markets, how to put up stop losses, how to manage the trading strategies. EPIC has started this EIP program, and we are learning, doing this particular program through our company, which is known as EPIC Learning Center. We are involved in different webinars, investor education and seminars. We write different articles for investor education, financial inclusion seminars. We do a query solving for all the investors and traders in the markets. Now a bit about EPIC Research. EPIC Research is the fastest growing advisory company in the country. We are now SEBI registered, Security and Exchange Board of India registered. We follow strict compliance rules, regulations, and we have a dedicated client services department which not only monitors the complaints but tries to create a process and a system in the company where each and every client of ours is satisfied and is making money in the market. We have been awarded by different organizations like NSIC, Samera, DNB, and recently we were given a Leadership Excellence Award. We have presence in countries like India, US, Australia, and Middle East, having around 10,000 satisfied customers and around 70 to 80% accuracy of our trading calls. EPIC Research is present in several domains like equity markets, cash, future and option, commodity, Indian commodity which is MCX, NCDX, international COMEX markets, currency which is Indian and iForex, international forex. We also provide premium research report. We also have a corporate research solution desk wherein we provide turnkey tailor-made corporate solutions, corporate research solutions to stockbroking companies, financial companies, banks, mutual fund companies. All the research solution which we have, we provide to the corporate solutions, corporate clients. Now this is the content flow, as in how the contents of this particular webinar would go. First, we'll be explaining the need of this particular webinar, that exactly what is the need of this particular webinar. Then we'll be moving on to the basics of commodity trading, trading strategies in commodity. Then we'll be covering the technical analysis of commodity market and then the question and answers. So this is how the whole webinar would be going. Now the need of this particular webinar. Exactly why do we need this webinar and why should you attend, why should you be very focused on this particular webinar. In India or maybe globally, the markets have become very volatile nowadays. So with the increased volatility in the markets, one needs to be very vigilant, very focused on the markets. One needs to be strategically aligned to the current movement of the markets. This is where the retail investor is missing the path. You talk about the investor in India, Singapore, US, Australia, Malaysia. We have many clients around the globe. We have many NRI investors who come to us for our advices. We have many HNI traders. We have many institutional clients who come to us, many broking clients who comes to us for the advice. And we have observed one common thing which is there with all the investors is that they lack proper guidance and proper trading strategies in the markets. So this webinar will give a short gist on how you can track the markets, how you can see the momentum of the markets, how you can see that where the markets are moving and where your stop losses and targets should be put in. Now, we often get queries from some investors that why do we need investor education? So today almost 95% of the retail investors lose money and only 5% make money. But remember, this is a zero-sum game, which means that if I am losing money or 10 guys are losing money, 1 or 2 is making money, because no money is leaked out from this particular system. So if I am losing money, somebody else in the market sitting on some other side would definitely be making money. So why isn't that a retail investor is always on the losing side? Also, less than 3% of Indians currently are exposed to the direct equity markets. Now, equity markets, as we have seen, let's talk about the Indian equity markets. The markets back in August 2013, September 2013 were at a very low level. If we talk about today, which is we are sitting in almost the near the end of the July month 2014, you take any stock on the street, every stock has almost doubled or tripled in this short period of 1 year. So equity is the only instrument which can help you beat inflation, which can make you earn money in this particular markets. But sadly and ironically, only 3% Indians are currently exposed to the direct equity markets. Whereas in countries like US, UK, which are developed countries, more educated countries, the investors are more aware, have 44% of the total saving of that country goes into the equity market. In India, 57% of the money which is being saved is kept in the saving bank account. So still the money is being sleeping in the saving bank account where you get a mere 4 to 6% interest. So if you take an average inflation of 7% and you are getting a 4% return on your saving bank account, you are still losing 3% on your money. So inflation is eating up most of your money, most of your capital. So instead of capital growth, you are making your capital degrow. So if you are keeping your money only in the saving bank account, at the end you are losing up the money. So your wealth is being distracted rather than being constructed. That does not mean that you should not keep your money in the saving bank account. In fact, you should ideally plan your finances, do a financial planning, and then invest your money in different assets. The asset allocation would be according to your financial plans, and then you should go out and invest and manage your assets. Now let us see some basics of commodity market, which is the Indian commodity market. The regulator in India is currently FMC, which is known as Forward Market Commission. There are two exchanges, MCX and NCDEX. MCX known as Multi Commodity Exchange, NCDEX known as National Commodity and Derivative Exchange. Types of commodities, 4 commodities: precious metal, gold, silver, base metal, 5 commodity: copper, nickel, zinc, aluminum, lead, energy, crude oil, natural gas, and agriculture. There are different agriculture commodities. So this is the basic structure of the Indian commodity markets for all those investors, traders who are very new to the markets and who haven't invested in the commodity markets. Our reason for taking this particular webinar on commodity market is that commodity markets are very volatile nowadays. If you talk about the agriculture commodities, the rains are almost there, so the volatility in many pulses, or maybe wheat, or maybe chana, or maybe soybean, we have seen huge volatility in last 1 or 2 weeks. Let's talk about the precious metal, energy commodities. Again, it is very highly news driven. So as the news regarding the different countries, different OPEC countries comes out, the gold and the crude oil move very hasty. So the investors, traders tend to lose very huge money in the commodity markets. So this is the reason we have thought that rather than only giving them advice on our products, why not train these investors so they can use those advice strategically and properly in the markets. As you can see in the next slide, the instrument which is there in the commodity markets is currently the future contract. The margin which ranges between 4% to maybe 10% depending on the volatility. Settlement happens on T+1 days. Expiry is between 3 to 8 months, and you can do positional short selling in these contracts. The non-agriculture commodities are directly linked to the US markets. So maybe gold, silver, or all the MCX commodities are directly linked to the US markets currently. The agriculture commodities are linked mainly to the Indian markets with an effect of global markets too. Now let us begin the whole technical analysis, the whole analytic part of the commodity markets. What a retail investor practically does. As you can see, this is the chart of the particular contract. What a retail investor does is, when the stock or when the commodity starts rising, he just waits and see and believes that, or maybe thinks that this is not the right time to enter, this is not the right time to enter, and then he misses the rally. When the rally is at the peak, he comes out and buys here. Sadly and ironically, the place where the retail trader buy is the highest point of the market, and from the next day the market starts falling. He keeps on waiting for the stock to rebound without putting a stop loss. He keeps on waiting and waiting, and then when the markets makes a bottom, he sells at this particular point. So ultimately what this retail investor is doing is he is buying at a place where he should sell, and he is selling at a place where he should buy. So this is where the lack of strategy, lack of knowingness, lack of willingness comes out to the market. So this is what we at Epic Research, we at Epic Learning Center wants to eradicate from the market. The retail investor is the hardly pressed. He is the investor who makes the most of the losses. He is the investor who does not put in strategy in the markets, and then he tends to lose the most in the markets. Now let us ask some questions from ourselves. But has every trader on the street lost money in the markets? So let me ask you, has every trader, each and every trader which you see, which you feel has a KYC account, has a trading account, is trading in the markets, has everybody lost money in the markets? Is the answer yes or no? I think and I know that most of you will be saying that, okay, yes, it's the answer is yes. Every trader on the street is currently losing money. But then my question again is that is if everybody is losing money, where the whole money is going? If I have sold something at 100 and the price is at 120, what about that trader who has bought from me at 100 and now he's selling at 120? Isn't that trader in making money in the market? Yes, he's making money. So we feel and we assume that everybody on the street is making losses in the markets, but that is not the exact picture. Because if one is making losses, another on the other side of the market is making money. Remember, this is a zero-sum game. The losses and profits are for the investors and investors only. Neither the stock exchange, neither the regulators, neither the companies which issue shares make profit. Only the shareholders which are trading in the market, who are in the trading arena, makes profit and makes losses in the markets. So not everybody on the street is making losses. So the next question is, why are you making losses? Let me ask this question to everybody who is in this particular webinar. Why are you making losses in the markets? And I am assuming and confidently assuming that 90% of those who are investing this particular, who are listening this particular webinar, are making losses. Correct me if I am wrong. I know that I am not wrong. And I believe and I know that 90% of you are making losses in the markets. And I've also started receiving some answers on the chat option that yes, we are making losses in the markets, which states that the need of this particular webinar, the need of this kind of investor education series is very, very important at this particular point in time. Sadly, what has happened that the stockbroking companies or the financial market companies are only focusing on selling and selling and selling. You go to a stockbroking company, okay, open an account free of cost, this brokerage, that brokerage. But what will you do of a brokerage when you are in the losses? I think and I believe and I would also suggest to the broking companies that rather than giving lower brokerage, you charge higher brokerage and educate the clients. They'll be more happy to pay higher brokerage and get educated rather than paying zero brokerage and making losses in the markets. Need of this particular R is education, education and education for the investor. So is making money purely on luck in the markets? No, it is not purely on the luck. It could be on the lucks and it is mainly on the strategy. Is there something known as trading strategy, technical analysis? Let us see in the webinar. Can a retail trader really earn and sustain for a longer time in the markets? Yes, if they trade properly. If you are a retail trader, you are not making money in the derivative market, leave the derivative market. Come out and trade in the cash segment. Buy stocks and delivery, wait when they rise and then sell when they have risen. Do stop loss really work? Yes, they work. We'll explain you how and what is a trailing stop loss strategy. So all these queries which I have asked from you will be answered in the whole webinar. So if you are really interested in learning, knowing, stay tuned to the webinar, listen every point and ask your queries freely. We'll be opening the forum freely for all to answer any queries you have, anywhere, any kind of queries. So don't feel shy, ask all kind of queries and note down all the queries. Let us move on further in this particular webinar now. Now, why do you exactly need technical analysis to make money? Let us understand that. Now, technical analysis is nothing but analyzing the markets, analyzing the trends, putting up some tools, and making those tools work for you in making money. That is what technical analysis is all about. Let us see this in practicality. As you can see in this particular chart, that we have made a chart, we have used some tools. Let me show you those tools. Now this is a tool which is known as Trendline, which is the horizontal trend line. As you can see, we have drawn this particular trend line. This is a straight trend line which we have drawn. Now what does this trend line shows? This is resistance 1. This was another resistance, and this was the point where the stock broke above the resistance point. Now this is a peculiar buy signal for a stock. When the stock breaks above a resistance point, you feel the stock is breaking above with huge volumes. There is a moving average breakout, then you trigger a buy signal. So this is what I am revealing, all the secrets which a technical analyst or which our research team do. We are revealing all the secrets. We are allowing everybody on the street, on the webinar, on anywhere around the world to come to our webinar, learn everything which we do in the markets and make money. We want every trader to make money in the markets. So this is how we have used a moving average and a resistance line, simple resistance line, in order to understand and in order to generate a buy signal. Now let us move to the next slide. Now risk return appetite. Now as you all know that the markets have some risk, the markets have some return. As they say, higher the risk, higher the return. And as they say in stock markets, only risk and no return. Is this right or wrong? I'm sure this is very much right. That most of the retail traders say that there is only risk and there is no return in the markets. Never come back to the markets, never invest in the markets. They keep on saying everybody, wherever they move, they are traveling, they are caught someone with the plane, in the plane or maybe in the train, and if they feel that this person is investing in the stock market, they start telling everybody never invest. On the next day you will find the same person sitting in the dealing room and trading again. The trader has a tendency that if I have lost money in the markets, I'll make money from the same markets. Leave away and forget what trading strategies. All these things are nonsense. Nothing known as trading strategies there. Nothing known as stop loss works ever. These all things are nonsense. Never talk about stop loss. This is what a retail investor thinks. But in exact situation, the risk return appetite is the most important thing which a trader or which an investor should have in the kitty. We ideally suggest that the trader should have a risk to return appetite of 1:3, which means if he is taking a risk of 1 rupee, he should try, or his strategy should be in such a way that a return of 3 rupees should come out. So this is the ideal risk return strategy. Now how you can maintain the risk return strategy, how you can keep on booking the profits at every level in the markets, let us see from this particular chart. As you can see in this particular chart, the stock has given a breakout from the double moving average. So it is a double moving average crossover breakout on the chart. As you see, as the share is rising, the trader is booking the profit. So let us assume the trader has bought 1000 shares here, and he keeps on booking profit at every level. This is the level which he has booked 25% profit. Another level which he has booked another 25% profit. Another level which he has booked another 25% profit, and remaining 25% he has booked out here. So this is how the whole trading strategy works for an investor. So as you can see, the trader is maintaining the stop loss, this red line as the stop loss, and he's kept on booking the profits at every rise in the markets. So this is how retail trader, retail investor can make money in the markets. He can invest properly in the markets. He can never miss the stop loss, because if you try to implement your stop loss and if you try to book the profits all at the same level, you will tend to lose the money in the markets. Because what if the markets come down drastically and you do not get an opportunity to book your profits? So ideally what you should do is you should keep on booking your profits at every price point. Now what is leveraging? Now what I believe and what I think, that most of the traders who are trading in the commodity markets understand and know what leveraging is. Leveraging is nothing but using limits in the market. So if you have 1 lakh rupees, you get a 20 times limit, so you can now trade at 20 lakh rupees. So ideally what you are doing is you are using that 1 lakh rupees to trade for 20 lakh rupees. So your risk is only 5%. So you have a huge risk to manage. Your capital is only 5%, 95% is your risk money, which is the borrowed amount. So leveraging is always very dangerous when you talk about the retail investor. It's a two-faced sword. If your bet is right, you'll tend to make money in the markets, but if your bet is wrong, you'll tend to lose money in the markets. Understanding stop loss. Now stop loss is that how you should restrict your losses, how you should minimize your losses in the markets, because it is more important in the markets to restrict your losses rather than make profits. Stop loss is nothing but putting a level in the markets wherein you feel that you should exit if the trade is making losses in the markets. So if you think that the trade which you have done, so let's say you have bought a gold contract at 30,000 and you feel that when it falls 30 rupees or 50 rupees from my cost price, I'll exit from that particular market. So this is where you can use the stop losses. Now let us again come back to the technical analysis side of the markets, which is the supports and resistances. Now as you can see, a support is a point where the stock or the commodity makes two simultaneous troughs. This is the first trough, this is the second trough. Trough is the bottom when the commodity or when the stock contract makes a bottom on the counter, is known as a trough. As you can see, when the contract has made a bottom, which is a support, it is known as a double bottom formation. The stock has again bounced back from this level and again started rising from this level to the upside. So this is a very simple but very effective tool in the technical analysis, which is a double bottom formation tool. So when the stock forms a double bottom, you can feel or you are confident that the stock would rise from this particular point in time. So whenever you trade, you can see that where the support or where the resistance of that particular stock is coming. Now let us see the resistance opposite of the support. This is the point where the stock is seeing resistance, which means the stock is facing huge selling pressure on the counter. A resistance is normally, and when the stock retraces from the resistance, it is a normal sell signal generated on the chart. Now this is how you can draw a resistance trend line. So a trend line is normally drawn by joining the peaks. This is the first peak, second, third, fourth peak. What I've done is I've joined these peaks by this trend line, and when the stock breaks above the trend line, you normally generate a buy signal on the stock. So this is how you can use the resistance trend line. Opposite of trend line is the support line. Now there are some troughs, first, second, third. What I have done is I have joined these troughs by making a trend line, which is a support trend line on these troughs, and whenever the stock or the commodity falls below the trough, below the trend line, you tend to generate a sell signal on the counter. So this is how the whole thing works. Now as you can see in this particular slide, this is the horizontal trend line. Now horizontal trend line is again made by joining either the troughs or the peaks on the counter. This is a very significant trend line, wherein if the stock breaks above below a horizontal trend line, the move is very, very significant. As you can see, the stock was making a trend. It was trading in a range with a support point, and when it broke above that particular range, the rise was very, very significant on the counter. So this is how you can understand and make out how the whole thing works. These are angular trend lines, and this is the main trend line. There are three kind of trend lines: main, secondary, and primary. So long term, medium term, and very, very short term. So a main trend line or a long term trend line could last from 2 to 20 years. So this is the main trend line. This is the short term trend line. And this is a trend channel wherein we have made a resistance and a support line, and this stock is moving in a trading range. So whenever the stock touches the upper trend line, it tends to retrace. Whenever it touches the lower trend line, it tends to retrace back again. So this is how you can understand, this is how you can make out that how you can use trend lines or trend channels where you are trading in the commodity, equity, currency, or for that matter any markets. These are some short-term trend channels wherein you can see these trend channels for a week, 2 weeks, 30, 40 days, or maybe in the intraday chart for 15 minutes, 20 minutes. So this is how you can play out with the trend channels, trend lines, which is a very, very integral part of technical analysis. When you do technical analysis, these trend lines, these trend channels, these trend patterns are very, very significant. Now let us move on to another indicator, which is known as a moving average. Now this is the moving average. If the stock moves above the moving average, you generate a buy signal. When it moves below the moving average, you generate a sell signal. It's a very simple tool to use. You have to take a call that what should be the duration of the moving average, 7 days, 14, 21, 35, or whatever the duration has to be made. This is a call, or this is a decision which the trader has to, or the analyst has to make. As you can see, this is the double moving average crossover or multiple moving average crossover on a chart. What we have done is we have used a 7-day and a 21-day moving average both on the same chart. So when the stock first moves above the short-term moving average, we generate first signal, and when it moves above the medium-term or long-term moving average, we generate the second signal on the charts. So this is how the whole thing works. As you can see, what we have done here is we have used the moving average as a resistance and a support line both. Out here, when the moving average was above the chart, it was acting as a resistance. Out here, when the moving average was below the stock, below the chart, it was acting as a support to the stock. So moving averages are very integral part, very important indicators. Although these indicators are very old, but still most of the technical analysts, most of the traders use this indicator as the regular part of the analysis which they do. Now let us move to the next slide, which is RSI, Relative Strength Index. Let me explain you this in the chart itself. Now RSI or Relative Strength Index is basically an indicator which reflects the strength of the chart. It ranges from 0 to 100, and this is the 14-day RSI line. When the RSI moves above 70, it is overbought. When it is below 30, it is oversold region. So this is how the RSI looks like. Let us see how you can generate a buy or sell signal using RSI. So out here, when the stock is moving above the 30 line, you generate a buy signal. When the stock moves below the 70 line, you generate a sell signal. This is how the whole thing works. It's a very useful indicator, especially for the intraday traders. You can use these charts in intraday, daily, weekly, monthly, yearly, or whatever charts you want. Now the next indicator is stochastic oscillator. Let me explain this to you on the chart itself. As you can see, this stochastic oscillator is the mix of two lines, K line and D line. So the K line is the baseline and the D line is the moving average of the K line. This is a 20/80 indicator, wherein if the stochastic is below 20, it is an oversold region. It is above 80, it is an overbought region. So you can do a double indication on the stochastic, as in if the stochastic is above 80 and it retraces below the 80 line, as you can see here, the main stochastic is moving below the moving average, you can generate a sell signal, and it is retracing above the moving average, you can generate a buy signal on the charts. So this is how you can this is how you can see how the stochastic oscillator works. So this was a bit on how you can use commodities, how you can use technical analysis in commodity market, how you can use proper trading strategies in the markets. you can try to make some money, make some trading strategies in the commodity markets, and what things you should keep in mind while trading in the commodity markets. Let me tell you a bit about the Epic commodity product profile. We have basically different kind of products for different investors. For the MCX retail clients, we have the BEP pack, which is base, energy and precious metal. A precious metal pack, which has only the precious metal calls. A base plus energy pack, which has base metal plus the energy commodities. For the MCX premium clients or the HNI clients, we have a PCG private client group, wherein each HNI client is given a research analyst, an independent research analyst. All the calls which are generated are according to that particular client's needs. We have an HNI group wherein a group of research analysts are given to the individual trader, and the calls which are generated are according to the trader's return appetite. MCX HNI pack. For the NCDX, we have a NCDX Agri pack for the retail clients. For the HNI clients, we have a premium NCDX pack. We have a EAPP plan, which is the point plan for the traders. We have a COMEX tips pack, which is for the COMEX international commodity traders clients. So we have all the packs for every kind of clients. At Epic, we also believe that trading strategy should be the core of the trading technique for the clients. We have some trading strategies. We normally generate a buy above or sell below call. So you should always follow those calls. Always keep proper stop losses in your trades. We should keep on booking profits and trail your stop loss as you are advised. Do not trade in trials. Whenever we give 2 days, 3 days trials, you should not trade in those trials. You should never over trade. Never trade on rumors. You should always consult our advisors in case of any confusion query. We suggest that you should maintain uniformity in your trading pattern. So do not increase or decrease your lots in the middle of the month. You should increase or decrease the capital from the starting of the next month. If you are trading in a single lot, you should book full profit in the first target itself. So these are some trading strategies which we have at Epic Research, and we believe that you should follow these trading strategies. This is where you can see our track sheets, research reports, weekly reports, and you can also visit our Singapore website at this particular point URL. This was a short on the webinar. Now the forum is open for any queries if you have. So if you have any queries, do put your queries on the chat and I will be more than happy to answer your queries. Okay, so we have received a query wherein they want to ask what is the importance of closing price down or up for the next day trading. So if the stock or the commodity is closing at the lowest point, normally what happens is that the next day the stock or the commodity would open lower and vice versa. Although this is not always possible, or that does not happens always, but this is a normal trend which happens. Okay, the next question is what is the ideal number of days for moving average and for double moving average? Ideal day is 7 and 14 day moving average if you are trading for a short term. For a medium term, it should be a combination of 7 and 35 day moving average. Okay, where to get the chart software? There are many chart software which is available in the markets which is free of cost. iCharts.in, or maybe you can just Google free technical analysis chart. You will get all the charts free of cost nowadays. Okay, so we should, another question is what should be the hourly, daily or weekly charts we should keep for a ideal momentum. Ideally, you should keep a daily chart along with a weekly chart. A monthly chart is too long for a short-term trend. Okay, so what are the charges of the different package? Sir, our packages are different, which starts from 5,000 rupees to 20,000 rupees per month. You can just put in a query at info@epicresearch.co. Our analyst will call you back and we'll be more than happy to serve you on that. Okay, so another question which is very important and I guess which is very common to most of the traders is that why does a stock ripple out or reverses when you feel or when you have seen a technical analysis breakout on that particular chart? What happens is technical analysis is basically a study which predicts the future prices based on the past patterns. Now, as you know, the market is surrounded with different news, different events. So an event which has not happened in the past or an event which is new to the markets tend to make the markets very, very volatile. So this is the reason where despite the technical charts and all those things, the markets move on the different direction. Okay, how buyer and seller ratio affect the intraday trading? So if the buyers are more and the sellers are less, we tend to feel that there is a buying tendency in the market and the opposite is the selling tendency. Okay, another question, is it the live chart which we get free? No, at these sites, these are the end of day charts which you get free. Also, I would like to share that there are many brokers out there in the market which give a trading software free, and on those software you can see the trading charts free of cost. So you can either go in for those charts. iCharts also charges 400 to 700. I don't know the exact price, but for the 400 700 rupees for a month for the live charts, you can go to that particular website, very good website. Most of the retail traders go to that particular website and you can hire those guys. Okay, so what is the effect of the economic results which they come or the datas which come on the copper or base metal? So if the data which comes for an industrial production or maybe the manufacturing data is positive, the base metal tend to rise, and if the stocks in the warehouse increases, the prices of the base metal will fall and vice versa. Okay, so do we have any free charts for MCX, NCDX? I would suggest that instead of going for a software, you can open an account with any broker which provides a good trading software, and you can simply Google that online trading software in India, and you will get many brokers which provide free trading software and you can see the charts in there. Which is the best pivot calculator, sir? Frankly, what I believe is instead of pivot calculator, you should go for Fibonacci calculators. Those are more accurate in the technical charts. Okay, for the intraday trading, what are the points which you should keep on remembering, keep on minding? When you are trading intraday, first and foremost thing is do not forget to put your stop losses. Second is you should not over trade in the markets. Third is do not take too much leverage in the market. So if you remember these 3 points, I think that you will make some money in the markets. Okay, the website is icharts.in, icharts.in for the free charts. Which is the time frame important for Fibonacci? You can take a daily chart, daily time frame for the Fibonacci. How does the housing job data affect the commodity market? Housing and job data are an indicator for the economic growth in the country. So if the housing data or the job data is positive or is growing, it directly affects the base metal pack, wherein if these datas are increasing, the base metals would increase, because if there are more houses to be made, there is more copper, aluminum, zinc, steel, etc. is being required. If there are more jobs, more requirement for the commodities would be there. So it is directly related to the base metals. Okay. So another question, which is a very good question and very common question, is how do we find the time frame of the targets? So normally, again, the Fibonacci charts will help you to find the time frame of the charts. There is another tool known as Gann chart, which would also help you find the time frame. Although these are a bit advanced tools, but you can try those tools when finding the time frame of the charts. Okay. Okay, there are some of the webinar participants which have joined late and they want the whole webinar. We'd also like to inform you that we'll be putting this video on our YouTube channel. You can go to the YouTube channel of Epic E-Marketing. You can just type Epic E-Marketing on the YouTube and you can go to our channel. You can also find the webinar videos of our past webinars on the channel. You can also go to the epiclearning.in site. Let me type the site for you. So I've just send a website to everybody, which states that on which site you can find all the queries, all the videos of our webinar. Okay, another query, what is the double top reversal pattern formation? So as you might have seen in the resistance chart which I showed earlier, that whenever the share forms a double top, there are two tops formed at the same point in time, and when the share reverses from that particular point, it is known as the double top reversal pattern. What is the best trading software? Although every software is almost similar, because the formulas behind those softwares are the same. There are some softwares in India which is Falcon, Iris, these are Metacode, these are some popular softwares. So rather than software, it is the trading strategy of the trader which makes the trade perfect. So now, as we don't have further queries, we'd like to thank everybody and we'd like to end this particular webinar. We thank everybody for attending this particular webinar, and we hope that this webinar was successful in making you a better trader, a better investor. We are doing another webinar on Monday, which is at 5 p.m. You can visit the epiclearning.org website and visit the register for that particular webinar on the site. Thanks everybody for attending this particular webinar. Thank you.